Hi, I'm Aradhana Aggarwal. I am a CPA, and my goal is simple to help everyday people understand taxes without fear, confusion, or jargon. What happens when your business becomes profitable? So now your business is finally profitable. Congratulations, you survived startup chaos, ramen noodles, and that one client who forgot to pay you for 6 months. But now that the money is actually rolling in, you might be wondering what happens next? Do I just make it rain? Not so fast. Today, I'll walk you through exactly what happens financially and tax wise when your business turns profitable and how to keep those profits working for you, not against you. When you start a business, losses are normal. You are investing more than you earn, expenses, equipments, marketing, coffee, lots of coffee. Then one magical day, your income finally beats your expenses. That's when you become profitable. Here is what that means. You now owe taxes. Yes, even if you reinvest everything, you might qualify for financing or partnerships. You need a real strategy for cash flow, not survival mode. Fun reality check: profit is equal to taxable income. Profit is not equal to extra shopping budget. Here is the first trap new profitable businesses fall into. Profit is not the same thing as cash. Your financial statement might say you made $80,000 this year, but if your clients have not paid invoices or you have reinvested all that money into growth, your bank account could still look sad. Profits live in your accounting system, not necessarily your wallet. So, lesson number one: don't celebrate based on profit, manage based on cash flow. That means keeping enough in your business bank account to cover taxes, expenses, and maybe even a proper paycheck for yourself. Crazy idea, I know. Okay, everyone's favorite part: taxes. Because when you are profitable, Uncle Sam officially puts you on his radar. If you are self employed, a single member LLC, or a partnership, your profit passes through to your personal tax return. That means you will owe income tax, self employment tax, that is 15.3% for Social Security and Medicare. If you have structured as an S Corp, part of your income will become as a salary with payroll taxes and the rest as distribution, which usually save you some tax. Either way, profitable businesses must pay estimated quarterly taxes throughout the year. There is no surprise bill season worse than April if you didn't prepare. The IRS doesn't do surprise parties, just surprise penalties. So once the tax money is set aside, what do you do with the rest? This is where profitable business owners start thinking strategically. The smart move isn't just reinvestment, it's strategic reinvestment. Ask yourself, what expenses will actually increase revenue or efficiency next year? Should I build an emergency fund, at least 3 months of expenses? Should I start paying myself a consistent salary or set up payroll? Profit is an opportunity if managed right, or a headache if you wing it. I have seen clients reinvest so aggressively they accidentally recreate their startup cash flow struggles just with fancier office furniture. Don't do that. When your business becomes profitable, it's time to start paying yourself the right way. If you are a sole proprietor or LLC, you take an owner's draw, no W 2, no payroll, just profits coming to you when available. If you are an S Corp or C Corp, you now pay yourself a reasonable salary through payroll with taxes withheld and then take distributions if you have more profit. The rule: treat your business like a separate from you because it is. Your business is not your personal piggy bank. This step turns your profit into something sustainable and smart, not just a lucky streak. Now that you're profitable, tax planning becomes your best friend. This is where the real money saving begins. Strategies might include setting up an S Corp election if it reduces self employment income, maximizing retirement contributions like a SEP IRA or solo 401k, reduce taxable income and build future wealth, tracking deductions properly, home office mileage, equipment, software, and keeping receipts organized, timing income and expenses strategically at year end. Tax planning isn't about tricking the IRS, it's about collaborating with the law to keep more of what you earn. Once you get profitable, the goal shifts: minimize taxes legally and maximize what you keep. That's when your CPA becomes your profit bodyguard. Profit changes more than just numbers, it changes your mindset. Suddenly, you move from can I survive to how can I grow? That means systemizing, tracking KPIs, and building forecasts instead of just praying the numbers work. It's about running a business, not just owning one. Profit is a beautiful thing, but is fragile without a plan. When your business becomes profitable, build cash reserves, save for taxes, pay yourself properly, reinvest wisely, and stay proactive with your CPA because profit isn't the finish line, it's where real business begins. Thanks for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.